gotta be flipping my flapjacks. 26 stocks that are on my buy list. We're about to go through them all in this video here today. 3 things you gotta know before we get into this. One is this list always changes. Stocks come, stocks go on this buy watch list depending upon many various factors. 2 is we're going to keep it pretty brief in regards to all these different stocks because it's 26 stocks, and so I'm not going to be able to go super in depth like I would for usually like my 3 or 4 stocks I'm buying videos I do each month. We'll just briefly cover these. And third thing is I ranked all these highest stock price to lowest stock price. So other than that, these don't have a ranking in terms of like this is my favorite stock of the bunch or things like that. Okay, appreciate y'all joining me as always. Thank you so much for being here. And the only thing I ask from you guys is make sure you subscribe to the channel. If you're not already subscribed, go ahead and hit that subscribe button. And also I appreciate everybody that subscribed on my reaction channel. We just went over 50,000 subscribers there on that channel this week. So phenomenal to see that growth in that channel. I appreciate y'all that watch not only this main channel, but also my reaction channel as well. All right, guys, let's start going through these. First one of these 26 stocks, I do not own it right now. And I'll tell you also if all these 26 stocks, if I own it right now, if I don't own it, right? Ulta Beauty. This is on my watch list. This is a pretty interesting stock. If you don't know Ulta, they're a big cosmetics company. They got physical locations all over the place. They also have a good online presence as well, e-commerce presence, right? And when it comes to Ulta, it's a pretty simple one, right? Not the most complex business model. They also, by the way, in a lot of their Ulta stores, they also can do your hair and you know, get a facial and other things like that, right? But in regards to Ulta, forward P on the stock 15, 2-year forward P under 13. Next year expected earnings per share growth, kind of looking at what analysts are expecting here, 12%. Looking at 1000xstocks.com. Next year revenue growth expected a little under 8%. If we just run some numbers, which I think these are pretty fair numbers for Ulta over the coming years, around 8% revenue growth a year, 2025 to 2028, and around 12% net income growth. That would put the company at net income margins of about 12% come 2028. Now, if you're saying somewhere between about a 15 to 20 P ratio, which is fair for an Ulta, right? 15 to 20 P is about fair for the stock. You'd be looking at somewhere around a $650 stock price to about $866, which gives you a compounded annual growth rate on the low end of about 15%, on the high end 23%. So Ulta actually looks pretty darn attractive here. Second stock of these 26 is Boston Beer Company. Ticker symbol on this one, SAM. It's a $269 stock here today. I don't own it as of right now. If you don't know them, they own a bunch of different brands. The Truly brand, Twisted Tea, Sam Adams, which just Sam Adams alone has a bunch of different like flavors and whatnot. They get the very popular Oktoberfest that I'm sure you're going to see in every dang grocery store and every store that sells beer out there over this next 2 months roughly, right? They also own, what's this one called? Angry Orchard, I believe it's called, which is fairly popular. So in regards to this one, it has a 2-year forward P on it of about 21 right now. Forward P is about 28. Next year, earnings per share growth is expected to be very strong. Basically, this company lost their way over the last few years. What happened is, obviously, Rona happened, right? And that really affected I would say, the overall alcohol industry, people getting together, which, let's be honest, like, Rona changed a lot of things there in the short term, right? There was no getting together. There was no going to the bar, no going to the club for a while, right? There was no, big family get-togethers for the most part for about a year or two there. Then we had a big kind of bunch of people getting together as the world opened back up and we could go do things again. And that was positive for the sales, but then they got too much inventory, it piled up, and in regards to them, like, inventory has to be fresh all the time because it's beer, right? So they kind of ran themselves into kind of a screwed up situation. So their profitability should come back very strong here. Now, if we run some projections here, and let's assume they can do about 6% revenue growth, which is kind of what analysts are expecting, and then run about 33% over the coming years, you'd be looking at a very nice CAGR here, which I think they could actually get here. 14% net income margins in 2028, and to do about $2.5 billion on top line, I don't think it's crazy at all for Sam, which would give you a very nice compounding annual growth rate on this stock. Next one up here, number 3 at 26, don't own it as of right now, is Lululemon. Ticker symbol Lulu on this one, $260 stock. Obviously, they have their retail stores that you'll see in a lot of nice malls. They're known for their yoga pants. They sell a lot of other items there. You can go to Lululemon and see, like, they got a lot more than just yoga pants, but let's be honest, like, that's their product that made this brand super famous, that got everybody to know it, right? That's what they're known for. And they've been facing more competitive pressure here recently. Now, this one, forward P on this one around 19, 2-year forward P around 16. Next year earnings per share growth expected about 13%. Next year revenue growth expected about 15% on this one. So if we run about 15% revenue growth, which by the way, their international opportunity is pretty immense, and they're just really starting, they're kind of in like, I think the first or second inning of their international expansion. They got a long way to go there. So I don't think it's crazy to imagine 15% revenue growth, net income growth of about 13% or there, right? Which would just kind of say they're spending heavy on marketing as they expand internationally. So kind of their profitability isn't able to keep up with the revenue in regards to this. And you saw up a 15 to 20 PE on this. You got a pretty good CAGR story here. Compounding annual growth rate on the low end about 11 and on the high end about 19. And those are very fair P ratios there. So I think Lulu actually looks pretty interesting here. The reason you might say, why haven't I bought it? I'm just still trying to figure out, is there a systemic overall problem with Lulu's brand? That's what I'm a little concerned about, because it is hard to grow into becoming a Nike, and that's what they really need to do to become this, to get to this next step, right? Now you're seeing here today, I'm using a lot of 1000xstocks.com. You're going to see that. If you want access to this service, I'll put his pinned comment down there today. You can apply for access to 1000x, my private stock group, my private wealth group, all those sorts of things. In the 1000x education portion, it's not just about all the software, different programs you get to use in regards to 1000x. It's also about the education portion. If you need help understanding balance sheets, income statements, cash flows, how to perform SWOT analysis, strengths, weaknesses, opportunities, threats, how to understand if a company has a strong moat versus a weak moat, how to value dividend stocks, how to value growth stocks properly, dividend investing, portfolio management, and many other subjects. If you need access to all that, pin comment down there. You're going to fill out an application. We see if we can get you access to 1000x as well as my private groups, okay? All right, guys, next one up here, number 426 is RH. I don't own it right now, and I'm sad. Stock's up 18% after hours right now. Yes, 18%. I'm not a happy camper about this at all. No, not at all, okay? Now, RH, very high-end furniture company. They don't have much for competition there, which is phenomenal. They're really going after the top 10% of income earners, the top 10% of net worth, and it's actually a pretty good strategy to really go after the top end here, because most furniture companies are really focused on the masses, right? They're focused on the middle class, and there's not a lot that really have scale, right, in really selling to high end. And remember, if you're selling to, let's say, somebody that, makes $50,000 a year, you got to understand how much they're going to spend on their furniture in an apartment they're going to get or a home. Very small amount of money, right? They might spend $1,000 or maybe a couple $1,000s on furniture, right? They're going to probably be at IKEA or some other mass market store. However, you sell to a high net worth individual who lives in a $10 million mansion, they're going to probably spend around $250,000 to around $500,000, right? You had an option. You had this customer or this customer. One you got to sell to $250,000 worth of furniture to. One you got to sell $1,000 worth of furniture to, right? So both can be successful, by the way. That's why IKEA is very successful. And then there's RH, which is very successful. It's just they cater really to the top end. Now, their latest, this is the numbers they just reported. Numbers weren't good. Their revenue was up a little bit year over year, which is nice, but their cost of goods sold went up to 54.8%. Gross profit went down for the company to 45.2%, right? Selling general administrative expenses went through the roof. It was up about $50 million year over year, and their revenue wasn't even up close to $50 million. Income from operations dropped to 96 mil from 151 mil. Keep in mind, this quarter last year wasn't even a good quarter for them. Interest expense for this company up 7.2%, right? Because of their debt levels. That's not good. Net income down to 3.5%. These numbers are bad. They're really bad numbers. But you might say, why is their stock going up? Well, there's a feeling that maybe their business is bottoming, right? And also, do remember they get to comp against these numbers next year, which will be nice for them, right? Because these are pretty pathetic numbers. And so hopefully they can report much better than this next year, right? And so, RH, I'm not in a rush to get in the stock. I still don't even know if tomorrow's move, the 18% move, I don't even know if that's going to be a real move. Like, I wouldn't be surprised if next thing you know, stock's back at 250 level. I don't know. We'll see. But for now, it's still on my buy list. Number 5 of these 26 is AMD, Advanced Micro Devices. I don't own the stock right now, but AMD is pretty intriguing here, right? AMD, forward P on this one, 43, 2-year forward P, 25. We do have to admit AMD's been getting their butt kicked by NVIDIA for really the past 2 years, but it's looking like AMD's positioned themselves much better for 2025 and beyond. Next year, earnings per share growth is a shocking 129% expected for this company. Obviously, next year, and then next year revenue growth expected 27% for AMD. Now, AMD, here's the deal, okay? If you want to run it at low PEs, I mean, the CAGR is not very exciting. But if you are expecting this company, let's say, command more of a 30 PE or 40 PE, then you could say the CAGR is going to be very attractive. I just want to run in here with very conservative PE ratios of 15 to 20. And yeah, obviously that doesn't look that great as far as the CAGR, right? 3 to 11%. But once again, double up those, and all of a sudden you're talking about CAGRs that are significantly above where we're at there. UPS, number 6 at 26. I don't own this stock, and first thing I want to say about this stock, it's a very sad stock. It really is. I went, this is an old chart for UPS going all the way back to roughly 2000 or so, right? The stock's up 97%. And all those years, like 25 years, and the stock has 97% gain to show for it. Really bad performance from UPS over time. We know they're a massive delivery company, logistics company, right? Now, I'm looking at UPS here. Forward P is around 16, 2-year forward P is 12. Keep in mind, just because the stock's been bad in the past does not mean it's going to be bad in the future, right? Next year, earnings per share growth expected 36%. They're expected to get their earnings per share growth going in the right direction again in a very substantial way. They're a company that inflation really screwed up their business model in the short term big time. Next year, revenue growth expected about 7.5% in this company. So if we run some projections here, obviously next year should be a great year for earnings per share growth, but let's say then it averages out to 8% after that. And let's say they do revenue growth on average of about 8% over the coming years, which I don't think is crazy to imagine. You're looking at a stock and you value the stock at a P ratio of 15 to 20, right? Net income margins of only 8%, so pretty bad, but it's a delivery and logistics company. Like, you're not going to command crazy net income margins on a physical business like this, right? Then put the CAGR on the low end of about 18%, on the high end of about 16%. So I think UPS is actually a buy here. Not the most exciting stock in the world, but I do actually think it's a moneymaker for the next 3 or 4 years. Next stock up here, number 7 at 26, is Elf Beauty. I do own this one. And I will say, very few times you could ever make 1,400% on a stock and you still feel like it's a buy. And looking at Elf, looking at the valuation of the company, the growth rates, stock is still a buy, even though I've made so much money on the stock over time. Now, I spoke about Elf extensively, literally less than 2 days ago. I did this video. I spent $32,000 on the stock today. That stock was Elf. And so if you want to hear me talk very in depth, I spoke about some other subjects in that video, but if you want to hear me talk very in depth about Elf specifically, watch that video, because that was, I think I dedicated probably 20 minutes or 25 minutes just to speaking at the beginning of the video. The first 20 or 25 minutes were just dedicated to speaking about Elf stock, okay? Next one up here, number 8 of 26, is Whirlpool Corporation. Not a stock I own right now. Nope, not a stock I own, but it's actually one of those stocks that is kind of like UPS in terms of it seems like a really boring stock, but I wouldn't be surprised if it's a really nice money maker this next 3 or 4 years. Now, like if we look out 3 years from now, 4 years from now, I wouldn't be surprised if Whirlpool's like a $200 plus stock. Now, Whirlpool, we know it makes appliances, refrigerators, microwaves, ovens, dishwashers, to do your laundry, all those sorts of things, right? But here's the deal, all right? Mortgage rates are starting to come down, and they're likely going to continue to come down. For my guess is they're going to continue to come down for the next 2 years. 2 years of mortgage rates coming down and down and down. And then I think they'll probably bottom out, probably stay there for maybe 1 to 2 years, and then they'll start probably moving up again. So we're going to be in a declining mortgage rate market for a while, and then I think we'll be at a kind of a stagnation of mortgage rates where it's not going to really go up or down for very much for an extended period of time. So I think the next 5 years are set up pretty good for a company like Whirlpool, right? And it's clear as day, obviously, mortgage rates have already started to come down. And keep in mind, we've been in these incredibly high mortgage rates for about 2 years now, over 2 years, which these are the highest mortgage rates people have had to pay in decades, right? You got to go really all the way back to about 20 years ago almost to see us anywhere remotely close. And even back then, we still didn't even get up to as high of mortgage rates as we really have been up to here recently. We've had a lot of mortgage rates recently of 7% plus, right? You didn't even have that back here in this situation. Nope. So the moral of the story is, in regards to these mortgage rates, is I think they're going to continue to come down. I think we could see an uptick in the amount of people moving 2025 through probably 2029. And I think that bodes very well for Whirlpool's business, because a lot of people, when they do move, they end up getting new washers and dryers and those sorts of things. And so ultimately, it's actually, I think, a pretty interesting stock. I would love to see it go down to a 70 level or 80 level, but even here, it's actually rather interesting, right? And we know mortgage demand's been the lowest, I mean, in modern times, really, over the past year or two. I don't expect that to last. I do think things will pick up 25, 26. And by the way, that doesn't mean pricing of homes will pick up in 25, 26. So a lot of people are assuming because demand's going to pick up in terms of people moving that suddenly that's going to make prices jump higher. You got to keep in mind there's going to be probably a lot of inventory that hits the market in 25, 26 as well, right? And so that's just something to factor in. If you talk about a higher unemployment rate, maybe people are a little bit more desperate. These are things to all consider here, right? So you could have a lot more people moving, a company like Whirlpool numbers improving, but the price of homes not necessarily going up. So just something to factor in. Number 9 of 26 stocks. I do own this one. It is a recent buy for me. It is Estee Lauder. This is a cosmetics company. They own a ton of high-end brands. They're very different than an e.l.f. e.l.f. is focused on the lower end. They're focused on mass market. e.l.f. wants to sell in Amazon. e.l.f. wants to sell on Target. e.l.f. wants to sell at Walmart. They want to sell at the masses, right? Estee Lauder, they want to sell more higher end, right? They're going to be in some of the more department stores. They're going to be in some of the more high-end cosmetic stores. They're going to sell obviously through their own websites and things like that, but they're going to sell they're a different price bracket. A lot of Estee Lauder's products are $50 and above, if not $100 plus, right? Whereas an e.l.f., on the other hand, e.l.f. will sell at $5, $10, $15, right? One selling to the masses. Everybody's e.l.f.'s customer. Estee Lauder, it's kind of more of an RH where it's like the top 10%, 20% of income earners, wealthy, those sorts of folks. I spoke about Estee Lauder, if I recall, extensively on 4 stocks I'm buying now, September 2024 edition. There's a 49-minute video there. So if you want to hear more about Estee Lauder, I believe that was one of the 4 stocks I spoke about there. Okay. Next one up here, number 10 of 10. This is a stock I own recently, and I've been buying the stock almost every week. Literally almost every week for the last several months. I've been buying Nike stock, Nike, NKE. I mean, this is a historic buying opportunity for Nike stock here recently. I don't think we'll get Nike at these sorts of prices that it's been here in 2024. I don't think we'll get that on Nike probably ever again. This is like a once in a generation type time for a stock like Nike. And so I look at this and I say, I've got to take advantage of this because I don't think, do I expect in 2026 to still be able to get Nike at $70? I don't. I just don't. I think this is that one freak time period we're going through here where you gotta snag shares of Nike. So we'll see. Now, by the way, Nike, if you want to hear me speak extensively about Nike, I think if I recall, that was one of the stocks I featured. 4 stocks I'm buying now, September 2024 edition, so you can check that out. Winning Resorts, number 11 of 26. I do own this stock. Smaller position for me. I want to buy this stock heavy for the next few months. Heavy. And the reason I want to do it, Wynn's another company that really caters to the high end of the market. A lot of the top 10% of income earners wealthy. You notice kind of a trend between a lot of these stocks I like to buy, right? But you know what is really intriguing about Wynn is, one, the valuation's on the floor right now. Incredible kind of buying opportunity here. 2, we're about to go into a rate cut cycle. That's probably going to last, I would say, at least a year, if not 2 years. A rate cut cycle that's going to be a 1 to 2 year rate cut cycle. It's going to be great for Wynn. Great for Wynn. We know these resort companies always have to take out a lot of debt to finance new properties, right? They might have to refinance debt, those sorts of things. And so Wynn sets up very well here with us going into a rate cut cycle now at this point in time, right? And so in inflation, not really an issue, shouldn't be an issue for at least a year. 2 years out, 3 years out, we'll see what happens with that, right? But as far as at least the next year, we're looking good. So the Fed's got the clear signals to cut. That bodes very well for Wynn Resorts in the end, right? And so their numbers are pretty much all-time highs across the board when you look at their numbers. Macau continues to come back year after year. Obviously they were closed for several years or partially closed for several years, and just, you see the major upticks continuing here. And this is in a China that is not even seen as strong right now, right? If China can really get some footing over the next few years and strengthen, it's going to help that Macau region in general, right? And keep in mind, Macau, that's not just like, it's just people from mainland China go to Macau. It's also just Asia in general. It's what Vegas is to North America, right? What Las Vegas is, my city I live in. What Las Vegas is to North America, Macau is that for all of Asia. And so that's just something to keep in mind. Like it's not just dependent upon mainland China, although there's so much money in mainland China, it's ridiculous. Like all the negative stuff you hear about, China this, China that, right? There's still so much money in China. It's ridiculous, okay? Ridiculous. So always do keep that in mind when you see all the negative stuff. Win is another stock I spoke extensively about on 4 stocks I'm buying now, September 2024 edition. So if you want to hear me talk in depth about Win, that video is the one to check out. Number 12 of 26 here, Shopify. Shopify. Listen, this stock's always an easy buy. This is very similar to an Amazon type story in regards to just one of those stocks you can feel comfortable buying it year in and year out and just buy and buy and buy and buy and buy, right? Now, obviously, it had the blow off top situation back in 2021, right? Everybody was forced to be home. E-commerce was crazy. Shopify's growth rates happened to be crazy at that particular time. And the stock market was crazy, right? Willing to pay all types of crazy valuations. And we know what happened with Shopify stock, right? Shopify will take out those old highs and go much higher. Shopify has the making of, if you're thinking about like what could be the next generation of trillion-dollar companies, right? And that's something I spend some time on, kind of always thinking like, who's the next ones in line over the next decade that will become like a trillion-dollar company? When I look at Shopify, I see the type of company there with the type of DNA that could reach a $1 trillion market cap someday. And when I think about Toby leading that company, when I think about their employee force, when I think about their asset-light business model, their innovation, continue to focus on more software-related things, right? And making their customers' lives easier, coming out with services in relation to that. When I think about their pricing power, I think they set up very, very well for not just the next year, but really they set up well for the next decade, 2 decades, right? And that's the way Toby's really engineered that company. So I love it. I absolutely love it. Now, I did a video back in February. Oh, actually, it was on Valentine's Day. See, I told you I love it. Did I not say I love it? I did this video on Valentine's Day. That proves how much I love that stock, right? I did a video on Valentine's Day, buy Shopify stock and don't stop. And that video went, 27 minutes in depth on Shopify. If you want to learn more about Shopify and my thoughts in depth about Shopify and why I view it as such a great deal, such a great opportunity for the next many years, you can check out that video there. Next one up here, number 13 to 26, we'll call this halftime. PayPal. I own a lot of shares of PayPal. If you watch my channel, you know this was a stock I was buying very heavily over the past, I would say, year or so, right? Very heavily. I own a lot of shares now at this point in time. So in regards to PayPal, they own not just PayPal, they own Venmo, and they own Braintree as well. Alex Chris, the new CEO, continues to have that company innovate at a rapid pace since he's gotten on board. I can only imagine like the new products and services PayPal is going to have in the market 2 years from now, 4 years from now, 6 years from now. That's just a little food for thought in regards to that. Now, I still went very conservative with my PayPal projections here. You can see why this is such an exciting stock, right? If we look here, I've been doing only 8% revenue growth per year, 2025 through 2028. When I think about all the innovation Alex Chris has a team working on, I gotta be honest, I think there's a decent probability Alex Chris is going to get this team back to getting the company back into double-digit growth rates, which PayPal has not seen for quite some time. But I didn't want to run it banking on Alex Chris being able to get the team to that double-digit growth. I said, let me still go more conservative. So I went 8%, even though I feel like as time's ticking on here, I'm getting more confident Alex Chris will get this company actually back to double-digit growth, which they don't need to for this to be a successful stock. That's the best part. Net income growth should outstrip the revenue growth extensively over the coming years as he runs his company lean and mean. So I think they're going to be able to do around 15% net income growth per year over the next number of years, which will put them in 2028 at a net income margin of around 18% here. And this company should command somewhere between about a 25 and a 30 PE, very similar to like American Express, Visa, those sorts of companies you can usually find a lot of times around a PE of 25 or so, which would put the CAGR on the low end, compounding annual growth rate of about 27%, on the high end about 33%. So PayPal is a pretty extraordinary opportunity. You can see why I bought so many shares of stock. And the risk reward, it's too attractive to pass up. It's too attractive to pass up. And so, yeah, they got a new marketing campaign that I absolutely love with Will Ferrell. Oh, man. I mean, I'm very impressed. Like, since Alex Chris has gotten here, whoo, baby. Like I told everybody before Alex Chris got hired, I said, this isn't a broken company. A lot of people thought this is a broken company. No, you look at PayPal's revenue, it's up and it's up and it's up. That's not the sign of a broken company. Revenue down, sign of a broken company, right? If your revenue is just going up and up and up, it's not a sign of a broken company. This was a broken stock. And it was a company that needed some tweaks to get them back charged to high gear to get this company going. Alex Chris is that perfect man. He's fixing the stock, getting analysts to understand the company better, getting investors to understand the company better. I'm already starting to see it. And he's getting the employee force to work on the things that really need to be done, doing these little tweaks to make PayPal better, Venmo better, Braintree, make the whole services suite. Partnerships are happening left and right with this company. Seems like every other week you're getting a major partnership announcement between PayPal and some major partner. I love it, man. I love it. So they're making all the right moves. Alex Chris is making all the right moves, and I'm very impressed with him so far. And obviously, PayPal sets up very, very well, and that's why I invest a lot in this stock over the past year, right? But it's arguably my favorite stock I've been buying over the past year. That tells you something, right? Next stock up here, number 1426. I don't own any of the stock right now. I used to own it back in the day, but I don't own any right now. It's Uber, Uber stock. So Uber, obviously we all know Uber. I don't need to describe Uber to you, right? It's a massive rideshare service and food delivery. Everybody knows Uber, right? But here's the deal with Uber. Their net income growth is going to exponentially outstrip their revenue over the next number of years, right? Really, especially 2025 to 2028. The company's really been scaling revenue for years and years and years. And that's really been their main focus, right? But it's about to shift more to net income, kind of moving forward here. So I have them doing about 12% revenue growth a year on average over the next number of years, while they do net income growth of about 45%. Now that puts them at a net income margin in 2028 of about 14%, which is still not the highest number, especially considering this company is really, the more I look at it, the more I'm like, Uber is kind of more of a SaaS type play. It really is, right? They're asset light. They're not the ones that own the cars. They don't own the drivers or anything. They're actually an extremely asset light business model. So to get to a 14% net income margin, 2028, I don't think it's impossible to do. Now, as far as P's go, 25 to 30, I think is about appropriate for this company, which puts it at a CAGR of about 14 to 19% come 2028. I think that's very impressive. So Uber actually looks really interesting. Now, you may say, what about the robo-taxi thing? Here's the deal. Uber's going to partner with other companies. They're going to be able to get that done. I'm not really concerned at all about that. And I do believe that, like, if we look out 10 years from now, right, which keep in mind, when robo-taxis start to scale in a meaningful way, I mean, it's going to be years from now, right? But I do believe that the two main players in that market will be Uber and will be Tesla. I think it'll be Tesla versus Uber. I think ultimately Lyft might end up getting bought out over time. I don't think they'll be able to get bought out by Uber, but I wouldn't be surprised if Lyft gets bought out by a Google or somebody like that maybe wants to try to play Waymo. If they can get Linda Khan out of the FTC, maybe. I don't know. We'll see. But anyways, the moral of the story is Uber. It's going to be Uber and Tesla long term in terms of my opinion. But for now, Uber's the big dog there, and I think their numbers are looking really good for this next bit of time. I don't own any right now, but I might own it in the future here. Zoom Communications, 15 and 26 here. I do own a small amount of the stock. I bought it recently. I want to own a lot more. And it's crazy. You look at the stock all the time. It's only up 2%. And it's fascinating to think the company in this amount of time became one of the most famous companies, certainly during Rona, right? Everybody zoom. And yet the stock has nothing to show for it. But I think it's an extraordinary opportunity. The income statement looks great for this company. The balance sheet looks phenomenal for this company. I'm talking top tier. Like, compare them just about against anybody, and you'll say this is one of the strongest balance sheets you'll ever find. And so I'm looking at this company. It's actually really, really attractive recently. I never thought I would own Zoom, but I had to buy some recently, and I want to actually buy a lot more, hopefully. So Zoom, it's not going to be the most exciting revenue growth opportunity. I had them doing only 5% per year revenue growth, 2025 to 2028. And then doing net income growth about double that, 10% per year over the next number of years. Net income margin is about 28%, which I think is about right for kind of a SaaS-related company, honestly, when it comes to Zoom. Pretty sticky business model, 20 to 30 P ratio on this one, which puts it at a CAGR of about 12% to 24% in regards to this one. I think that looks pretty good. And I actually like Zoom. It's actually a buy. It's a buy, man. You never thought I would say it, but it's a buy. Etsy, number 16 to 26. I don't own any of the stock right now, but don't be surprised if in the next few months I start a position here. It just got kicked out of the S&P 500. Boom, you're out. Palantir's in, okay? Now, that puts a lot of selling pressure on the stock, obviously, right? people are going to sell it, and then people are going to be forced to sell it since it's not in the S&P 500. So there's going to be selling pressure on Etsy for probably the next 3 months. And that's where I look at my opportunity here in regards to starting a position here. And remember, there's going to be likely tax loss harvesting on this one as well coming in the next 3 months. So you got being kicked out of the S&P 500, compounded with tax loss harvesting like in the fourth quarter. It makes for a very ugly setup for Etsy stock in the short term. A stock that's already been taken out and kicked out, right? Awful. Now, Etsy has actually a really nice market that they kind of own. And it's this market of, essentially you want something custom made. You want kind of, non-generic type, Amazon type stuff, right? Amazon's a place you're going to go if you need some elf makeup, right? Amazon's a place you're going to go if you want to order, a new monitor for your TV, like general merchandise like that. Etsy's the type of place that you're going to go if, you're looking for something special for somebody's birthday or a holiday or something like that, right? Something cute. That's where you're going to go for Etsy. Somebody might make it in their own living room for that matter, right? And so there's kind of a little bit more of a community feel around Etsy. And that's a nice market for them. And honestly, there's no one that really competes there very well when I look out. Shopify, that's not their specialty, right? Shopify can enable small businesses to do that, but it's not really their specialty. Amazon, it's not really their specialty, right? They're kind of more focused on mass general merchandise. eBay, not really their focus either. They're kind of more general mass merchandise, but in an auction form. So Etsy has a nice market here. I actually like their market, right? Now, the other interesting thing is you look at the forward P, the 2 year forward P, 20 and 18 in the stock, right? And this is still an early days business model. Like 5 years ago, did anybody really hear of Etsy? Not really, right? This is still an early days business model here. So the fact that it's at those sorts of PEs and might go lower here in the short term, given everything I talked about at the front, it's going to actually get really interesting in regards to Etsy. Now, I put this company at very conservative numbers of only 10% revenue growth a year, 2025 to 2028, and net income growth of only 10% a year for the next 4 years, right? And I kind of did that because I figured Etsy's going to probably market pretty heavy over the coming years. And so I don't think they'll get much leverage in regards to getting that net income up further than their revenue, right? Which puts them at net income margins of only 10%, which is not very good for really an asset-like business model like Etsy, right? But I wanted to run those, right? 20 to 30 P on this one still gives me a category of about 8% on the low end and about 20% on the high end. I like that from Etsy. So I got to say, Etsy, don't be surprised if I buy the stock here coming up, right? Monster Beverage. Number 17 to 26 here, folks. I do own it. Just bought it recently. I did own it way back in the day. It made me a lot of money. It was great stock for me. And I just bought it here very, very recently. I mean, very recently. And Monster, if you don't know Monster, where you been at? Okay. Energy drink giant. Energy drink giant. Going to just about any convenience store pretty much in the world, but certainly in the developed world, you're going to find Monster in it, right? Like, they're a monster. So in regards to Monster, 27 forward P, 2 year forward P, 23. It's for a company that has growth and as a drink company, that's about what you would expect to pay, 25-ish, somewhere in there when it comes to kind of forward P on the stock like this. Like, if you got growth and you're a drink company, like, you're going to command that because people look at it as a stable, addictive business model, right? Next year, earnings per share growth in Monster is expected to be over 20%. Next year, revenue growth expected at about 15% on this one. When it comes to Monster, I ran my projections here, 10% revenue growth a year on average and 15% net income growth on average, right? Puts it at net income margins about 28% come 2028. Isn't that fitting? 25 to 30 PEs, fair for this company. And that gives a CAGR of about 11% to 16%. So, decent, right? Decent. I think Monster is it's not the most exciting buy, but it's still a moneymaker, and I wouldn't be surprised at all if Monster outperforms SP 500 over the next 4 or 5 years. Cake. Cheesecake Factory. Number 18 and 26. I do own the stock. I bought a lot of this stock this year. A lot of this stock I bought in 2024. I love it. So in regards to Cheesecake Factory, there's 3 brands you got to know. One's Cheesecake Factory brand. I mean, that's the cash cow. That's the super famous brand. Even, some would say worldwide famous, but certainly United States of America famous, right? And then I have North Italia, right? North Italia, you have to know North Italia. North Italia is a, up and coming Italian chain that is higher end than like an Olive Garden or something like that. Very good quality food there. People like to drink a lot of North Italia. And they have another growing brand, which is called Flower Child. This is another one you got to know. Very fast growth from Flower Child, okay? Now, when it comes to cake, forward P of 11, 2-year forward P of 10. Next year, earnings per share growth expected 14%. Next year, revenue growth expected around 8%. So for cake, I'm expecting around 9% revenue growth on average, 2025 to 2028. And I'm expecting net income growth of the same, which is pretty modest, right? That puts at net income margins of 4%. It is a restaurant industry, so it's a tough margin industry. We do know that, right? Now, I believe cake's about to go through, over the next number of years, basically an uptick in regards to PE ratio. Right now, the company's super disrespected because people aren't educated on this company. They think it's still just like the Cheesecake Factory brand or something like that. When I'm like, no, they own a bunch of, by the way, other restaurant concepts outside of North Italian, Flower Child, and Cheesecake. But like the opportunity for North Italian Flower Child is so immense that I think people will begin to understand that over the next few years and get educated on that. And so you'll see a big PE upgrade for the stock, I think, to kind of the more 25 to 30 range, because the company is going to start putting up very nice growth year in and year out. And I think people will start to recognize, when I say people, I'm talking investors, that, oh, this is a higher growth company. Is it going to command a 50, 60, 70 PE ratio like Chipotle commands or something like that? No. Is it going to command a 100 plus PE ratio like Wingstop commands? No. Is it going to command a 75 billion PE like Cava has? No, okay. But I do think there's going to be a nice uptick in regards to PE ratio, which gives me a CAGR on the low end of about 30 and on the high end of about 36 here. So a cake's a pretty extraordinary opportunity. Oh, and it's a dividend payer as well. So I get to make that dividend money. Plus, I think I'm going to get great share appreciation here. I think it looks pretty good. 1926, just bought this one along with Monster. Celsius Holdings. The stock has had an epic, colossal crash. And it's actually gotten to prices that I said I got to step in and pick up some shares here. Now, Celsius, there's another energy drink company, right? Very well known. No one heard of it 5 years ago, and now it's everywhere, right? Very, very successful. 2-year forward P on this one's 20, and it's interesting because Celsius is very early in their profit journey. I mean, very early days. And so the fact that this company's trading this cheap, this early on in their journey is interesting. And I've done a lot of thinking about, do I think their business model is broken? Do I think there's some systemic problem with their brand? And the answer to that is no. I think there's problems with their short-term numbers, no doubt. But I do not think that's lasting past the next couple quarters here. And I think this sets up very well for 2025 and beyond in regards to this one. I spoke extensively about Celsius stock in this video right here from 8 days ago. 2 new stocks I bought today with a cowboy hat, okay? If you want to hear me speak extensively about Monster and Celsius, watch that 40-minute video there. I spoke extensively about both those stocks in that video. Next one up here, number 20 and 26. Don't own it right now, but I might. Bath & Body Works, 27 stock here today. Ticker symbol on this one's BBWI. And this is a company that, if you don't know them, White Barn, Bath & Body Works, they sell soaps and candles and all that sort of like smelling good stuff, right? They do a lot of business in fall time. They do a lot of business in winter time as well for their fall time related soaps and candles and things like that. And then winter time for Christmas type stuff, right? This one, it trades just so dang cheap. Forward P under 10 on this one. I do not think it's a broken business. I do not think it's a broken business model. If I thought that, then I would say even under a 10 forward P, I wouldn't touch it. I don't think this one's broken. I think this company is going to be just fine. Now, their balance sheet's crap at this company. I got to be honest. Their balance sheet's but we're about to go into a lower interest rate environment for the next many years, in my belief, that is, right? So being that we're going to go into a lower interest rate environment for the next several years, and being that the forward P is under 10, it actually looks like a pretty attractive buy here. And so we'll see. I don't own any right now, but I would not mind adding some here in the next bit of time, because they got a very nice market there. Next one up here, number 21 and 26, is Mattel. It's an $18 stock here today. Ticker symbol on this one's MAT. So when it comes to Mattel, you should know them as a toy company. Barbie, Hot Wheels, Fisher-Price, American Girl, Uno, Mega Bloks, all these sorts of different brands they have, right? And then they'll partner with other brands where they'll do like licensing deals and things like that. We all know the Barbie movie was exceptionally popular, right? Now, Mattel, it's a very cheap stock, and it has very low expectations here. Next year earnings per share growth of 10% roughly. Next year revenue growth expected very small. And I like what they're doing kind of in the movie space. Supposed to have a Hot Wheels movie likely coming out. The Barbie movie was insanely successful, like literally one of the most successful movies in a long time, right? Was it not? Like that was incredible. So I like Mattel, man. I really like Mattel. I might buy this one. And by the way, if you think like kids don't play with toys anymore, they do. Trust me. I have 3 little kids. They all play with toys. Okay, kids still love toys, and I don't really see that ever changing. I know we're in the online time frame of iPads and phones and things like that, but I think especially as parents are getting more educated on you can't just give your kid a device all day. Toys come in handy big time. Now, UiPath, number 22 at 26. This is one I'm doing more digging on. So it's $12 stock here today. Ticker symbol this one, PATH. I still doing work on it. I don't own it right now. I got more work to do there. SoFi Technologies, $7 stock. Ticker symbol this one, SoFi. Listen, we all know there's a whenever you buy a bank stock, you always have to be prepared to lose 100% of your money, right? That is honestly any stock. You got to be prepared to lose 100% of your money, right? Hopefully you get out way before that happened because you see the writing on the wall and the numbers and you get out, right? But at the end of the day, you always have to be prepared to lose 100%, and especially with the bank, right? Somebody could get over leveraged and loans could go bad, and next thing you know, the FDIC has to take them over or something like that, right? So we all know when you buy a bank, that's the risk. But with basically every other bank and every other bank stock, there's very much a limit on how much that stock's going to really go up. And the reason being is these companies, they have trouble taking any market share and really adding any substantial amounts of customers, adding, any substantial amount of increase in regards to assets under management, and they don't really have a tech side to them. SoFi's different. SoFi's taking market share. They're increasing their market share immensely, right? They're taking customers. Their assets under management continues to skyrocket. They have a tech side of their business as well in regards to Galileo. So the company sets up in an absolutely epic way. And so the way I look at SoFi is you're buying a bank with unlimited upside, literally unlimited upside over this next 10, 20 years. And they're honestly the only financial institution I've come across that I truly believe they have a great opportunity to become a giant in banking. It's the only one. It's the only one I know of that I've ever looked into that I'm like, they're not a giant today. They're actually really small compared to these other guys, but they have an opportunity over the next 10, 20 years to become a giant, right? To get in the same sentence of a Goldman Sachs or a JP Morgan and those sorts of guys, right? Bank of America, Wells Fargo, like up there. So yeah, it's very, very attractive. Goldman Sachs, JP Morgan, all those stocks, like they can be fine stocks. It's just they have such limited upside, right? Now, in regards to SoFi, I talk about SoFi quite a bit on the reaction channel. I'll react to Anthony Noto goes on CNBC every once in a while. I react to that. And then additionally, there's always news in regards to SoFi. So I react to a lot of that on the reaction channel. So, if you don't follow me on the reaction channel, you might want to if you're interested in SoFi at all. Now, the Honest Company is number 24, 26 here. Stock's about $4 here today. Ticker symbol HNST. They sell diapers and wipes and beauty products and soaps and lotions and all those sorts of things. Go to Target, go to the cosmetics area, go to Target, go to the baby area. You're going to find a lot of Honest products there, okay? I own over 50,000 shares of Honest. I love the way this one sets up. Carla's been doing a heck of a job at the company. This is Carla's time period since she came over the company. 21% growth, 7%, 1%, 10%, 3%, 10%. She's getting the revenues going back in the right direction here, and she's also getting the earnings per share back. I mean, they were taking big losses, and then she's really got things turned around the past 4 quarters here. She came over at the beginning of 2023, and she turned the ship around quick, man, really quick. I was shocked. And look, they beat 4 straight quarters in regards to earnings per share, including some that were significant beats. Additionally, every single quarter since she's been at the company, they've beat on revenue. Every single quarter. So I think she's doing a heck of a job here, and I think we got a great turnaround candidate on a very cheap price to sales ratio here. So I think Honest sets up phenomenal for the next several years. They are always a potential buyout candidate. That is something to keep in mind as well. I don't think they should put themselves up for sale yet, my personal opinion. Get this company out of the gulag. The gulag's $5. Get them out of the gulag, right? Continue to expand the company, revenues, profitability, and then we can talk maybe 2026, 2027, maybe then you would want to explore a sale to a bigger company at that point in time, right? I think there would be a lot of people in the market for an Honest, right? Because it's one of the very few growing brands that really resonates with kind of the millennial generation and Gen Z as well. So I would get the company out of the gulag, which I think they'll get out of the gulag in the next few months. So I think they'll get it back above 5, get them back to double digits, stock price somewhere in the $10 to $20 range. And then I would start exploring the idea of potentially selling the company, right? For maybe somewhere in the $20 to $30 range at that particular time, right? Get them onto solid profitability. And I think that a lot of brands would be interested because they would see the revenues going up, right? They would see the brand that resonates with the younger generation. And additionally, on top of that, they'd see, this is a profitable company. It's going to be margin accretive, and it could be actually earnings per share accretive to a bigger brand. Whew. Yeah. Then you could talk about, a buyout at $25 or $30 at that particular time. So Carla's just got to keep going here, and I think she could end up making a boatload of money, like a lot of money. I think she could end up making for herself, and obviously, being somebody that turned around the company in an amazing way. And she's been part of deals in the past, right? She took over the Annie's brand after that was acquired by General Mills. Annie's is a stock I used to own back in the day, way back in the day, in like my Whole Food days back then. So, anyways, long story short, things are going much better at Honest, and I think they're going to go a lot better. And I think you're going to start seeing this company be profitable quarter in and quarter out with revenue growth. Woo, that's going to be very exciting. Fubo, next one up here, $25.26, $1.80 stock. Ticker symbol on this one is Fubo. So, man, I got to say, for a while there, it just seemed like everything was going against Fubo. Now it just seems like everything is going with Fubo. So Fubo had a very favorable ruling here recently in regards to their lawsuit against Disney, Fox, and Warner Brothers, right? And in regards to blocking the venue service. So that's their first win. This is their second win, in my opinion. The trial date has been set for October 2025 in regards to this antitrust lawsuit. This is the best situation for Fubo. So now that takes this venue or potential service out of being next football season either. So now you don't have to worry about it this year. You don't have to worry about it next year, right? And Fubo's already looking, and honestly, you might never have to worry about it. I would say the odds that you ever have to worry about it in general are pretty low as well, right? This also gives time for Fubo to get more information, get more negotiations with these companies, right? And meanwhile, the lawsuit is pending here. So these companies have to be very careful with how they're going to even negotiate with Fubo now at this point in time, right? And if they do anything funny, Fubo's going to use that in the lawsuit. They're going to expose that, right? So, this is going to be very interesting to see how this all shakes out now. So this is very favorable for Fubo. Like Fubo's really actually genuinely winning in regards to the situation. And this could settle way before October 2025, by the way, which we'll see if they do. It would be intelligent, in my opinion, for Disney, Fox, and Warner Brothers. I'm just going to tell you guys honestly, it would be an intelligent decision if they settle before October 2025. That would be the best case scenario for them. In my opinion, I don't think they should let this go to trial. If they let this go to trial, I think Fubo is going to air a lot of ugliness out there, and Fubo has time to get other companies and partners in. I mean, trust me, man, there's a lot of funny stuff that's going on there. So I'm just saying, like, those companies should just settle this, get it done, get it swept under the rug, do business with Fubo, give them fair rates, right? Mind your business, and there's bigger fish to fry. You don't want to die in this hill, in my opinion, if you're Disney, Fox, and Warner Brothers. It's David and Goliath situation. I don't think it's a good look for them. Nah, don't do it, man. Don't do it. Like, that's all I'm going to say about that. Don't do it. So Fubo, Google Trends are going crazy again. Football season's back. College football season, NFL season's phenomenal. So Fubo's back to tearing it up. And they continue to bring down their losses as well, which is substantial and very important for this company. The Planet to number 26 at 26, 62-cent stock here today, PLNH. Ticker symbol on this one, I do own it. I love it long term, but I really love it the next 12 to 18 months. And the reason being is the Vegas Superstore, from what I've seen recently, oh my gosh, this store is starting to do so much business. They've completely fundamentally changed how they're really doing business there, and so many different avenues of business that's bringing in traffic to the store, and they just keep adding more and more and more. So I think the Vegas Superstore numbers are going to be ridiculous over the next 12 to 18 months in terms of growth rates. Additionally, on top of that, right, Top of that, Florida, they're going to have full acquisition of everything going on in Florida. They're supposed to have 30 plus stores in 2025. I think the Florida growth is going to be ridiculous for this company. Orange County sounds like it's getting in a better place than it certainly was in the past. So I'm looking at Planet, and this one's looking tasty. Very, very good for the short term and for the long term. Now, if we could have any sort of federal legalization happen, that could be big. And honestly, it seems to me like Harris and Trump are both kind of pushing that way, so which is good to see. I spoke about Planet extensively in 4 Stocks on Buying video, so if you didn't get checked out that, you can. Pin comment down there if you want access to 1000xstocks.com, access to my private stock group, wealth group, learn everything I got up here. Pin comment down there to apply to join us in there. Much love and have a great day.